It's the smart landlords, the ones that have reserve accounts, that are going to be the ones that can make it through. And again, when you're looking at buying a building, make sure you have a damn good reserve account. That's something that I've looked at on myself, and I feel pretty good about my reserve accounts. But in the future, my reserve accounts are going to get even bigger.
Yeah.
And I'm going to be even more prepared for this to happen in 2025, in whatever.
Yeah.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it.
Hi everyone, Daniel Kurkowski with Obsidian Group. Today I'm joined by Todd Dexheimer of so many things. I mean, podcast host, apartment syndicator, construction company, management company, Venture D. That's the main firm. When I think of you, I think of Venture D. But today we're going to get into COVID-19, how it's affecting the economy, our opinions on it, and just the general state of affairs. So
there you go. A lot of stuff.
Thanks so much for making the time.
Yeah.
Let's get to the first question. You own how many apartment units right now? Are you sponsoring?
Own about 550-ish right now. I kind of lose count because I've been selling a little bit of stuff and then still trying to acquire.
Sure. And we were talking a little bit before this started. What percentage of your tenants are paying on time?
Well, we've got properties all across in different locations. So there's different stats, and the stat that I was telling you was local stat.
Sure.
Locally, we've got, I said 100%.
Yep.
And it's really, there's one tenant that hasn't paid, but we already had evicted them, and we were actually going to file the writ, and then all this happened.
Sure.
So they have still not paid. So technically we have whatever that is, 98% or whatever it is.
Sure.
That have paid. But
largely unaffected by this.
So far,
which is good. Because you have heard, I've heard anecdotally 30% of tenants kind of across the country were late. I don't remember where that stat came from, but I have friends who did that as well.
But here's the thing, in 30% were late, yes, but I think a typical month is right around 18%.
Sure.
So we have to look at collections kind of at the end of the month, and I think what'll be interesting to tell is right now stimulus checks are starting to come out.
Yep.
People are finally getting their unemployment. You've got that $600 extra boost onto unemployment. So those things are all coming out.
Sure.
So what happens when that actually hits people's bank accounts? Are they going to get caught up on rent? And when that continues to flow into their bank accounts, are they going to continue to pay for May, for June, for July? And that's really all it's good for, right? Through July.
Right.
And so then it'll be really interesting to see what happens in August and September. Does the government come out with more money? We seem to have an endless supply of money, which is fantastic, right?
Right.
But it'll be interesting to see kind of what happens there. Is there more money that comes out? Are we back to kind of life as, quote unquote normal? I think normal is a new normal, but at least some sort of resemblance of normal life. Be interesting to see. So.
Yeah, I think the biggest unknown that makes it so hard to predict anything going forward is how long is this going to last?
Yeah.
I think that it's undeniable that there's going to be economic impact. And to be honest, I don't think we've even felt it yet. I think right now we're dealing with the actual virus and how that's affecting the economy. I don't see sort of the aftershock, the fact that the balloon was maybe a little bit overinflated before this took place, being really something that's taking effect yet.
Yeah, I would agree. The majority of your companies, Dan, are at least capitalized for a month or two of unknowns, right?
Yes.
Now, good companies, good, well-positioned companies have 6+ months, likely 9 to 12 months worth of reserves.
Sure.
Now, I think it was just today, and I haven't officially fact-checked this, but Neiman and Marcus just announced bankruptcy.
Wow.
So that's a company that's been around for a long time, but it's a company who's been struggling for a long time. There's talk about some of these companies like JCPenney's and Macy's and some of these department stores that are kind of weaker around, the surface and where do they really have like this 6-month reserve? What can they do to withstand anything? They were banking on a good economy and still struggling.
Right.
So what happens when the world gets turned upside down? That's going to be the interesting part. What's the landscape going to look like when we exit this?
Yeah, I think you're right. And I think the good news is, as a whole, long run, I think we'll do well. We'll reposition a lot of those businesses. But there's sort of this frictional difference where, they talk about frictional unemployment, which is the idea that just the time that it takes for an employer to find the right employee. Well, there's going to be a lot of unemployed people in some businesses that are disappearing. Yeah. New businesses will come in and take their place. But what does that timeline look like? How long is it going to take for those two to kind of find each other in the market? So there might be some supply shock on the labor market side.
Yeah, I 100% agree. I mean, out of this opportunity is bound to come about, and great changes are going to happen. Things that are exciting, things will be brought to the forefront, and they were going to take 5 to 7 years, maybe 10 years, and all of a sudden, within 2 years or 6 months, we're going to have this kind of new paradigm that we didn't realize until now. Unfortunately, with that, some people will get left behind.
Absolutely, and that is the hard part. And I don't want to be one to complain. We're well positioned and fortunately made some lucky decisions, coupled with some good decisions to be in a good spot right now. But I don't know what your thought is, but as an owner of real estate, I feel like there wasn't a ton that really went on that was designed to help me carry through if I have unpaying tenants, particularly on the commercial side. What do you feel like the response has been from the perspective of a landlord?
Well, I think landlords definitely are not being helped, and I don't want to sound whiny and say, "Oh, we deserve to be helped," because quite frankly, I mean, I can understand some of some of the negativity and all that, but here's the thing: is landlords just weren't helped out. I don't know of any landlords that have been. I haven't been. I think the biggest thing that's disappointing to me, it's not that I want to go out and evict all my tenants. Like that's the furthest thing from my mind. But the fact that evictions just poof went away.
Right.
And but we can't have people in the court system. I get it, but we do have computers, right? We do have a way to still do these things. Well, we don't want a bunch of people getting kicked out of their property. I agree, 100%. We don't. But here's the problem with no evictions is that now we create this sort of entitlement, and I don't want to rag on people and sound super negative, and that's not my point. But the eviction was kind of a, hey, look, you do have to still pay your rent. We don't want to file eviction, but it's still there in our back pocket, where now it's not even in our back pocket. There's no repercussions, period.
Right.
And again, I'm not right now, that's the furthest thing from our mind. We're not wanting to evict people. But if somebody says, look, we're not working with you, go get lost. Yeah. I'm not paying rent, and I don't care. I don't care how much money I have. I don't care. I'm not paying you a dime.
Right.
Well, then we got problems, right? That's a different kind of scenario, and it's like, okay, why shouldn't I be able to say, okay, that's fine. You say you're never going to pay us, but you know what? In return, we're just going to ask you to leave. But we can't do that right now. We can't say you have to leave. So I think landlords have been not only have they not been helped, but they've actually been hurt a great deal. And there's some legislation right now that would be very damaging to landlords. I don't think it's going to go anywhere. I think it's more of a publicity stunt. But at the same time, it's concerning that it's even out there.
Are you talking about Omar's bill?
Yes. Yes, where, rent and mortgage payments would be forgiven, and the cities and the government can come and buy your buildings from you, and it's socialism at its best.
Well, yeah, and I don't think anything that you're saying is complaining or would be interpreted as complaining, but it's important to have the conversation so that we actually know how best to strategize going forward. If it is going to be something for a landlord where they know that going forward they likely will not have much help, they need to change their strategy. How are they going to move forward more effectively? And that's why I think this conversation is so valuable.
Don't count on others. Look, I mean, that's the first and foremost. And I think there's a lot of businesses that should feel very fortunate. Yeah, and there's a lot of businesses that are like, I'm getting totally the wrong end of this thing, and I had to shut down, and I didn't get any government support. But at the same time, you just can't count on it. And if you set your business up to where you're not counting on it, you're fine. And that's why I talk about how much reserves you should have. Like, if you're buying rental properties, you should have 9 to 12 months worth of principal and interest reserves. Or if you're buying some smaller properties, single family, small commercial spaces, it might even be up to 6 months worth of just total all payments. It just depends on the size of the property. But
if I had to pick a theme for the response to this crisis, I would say moral hazard, which is the idea that you're allowing someone to make a bet without having them worry about what the downside is. They only get the upside.
Yeah.
Right. So you can see that through the buyout of junk bonds. Right.
Yeah.
The people who invested in the safer, more conservative bonds, they're essentially the ones who are being punished. And you, as a responsible landlord, someone who set aside reserves, if they're not doing it, but say there's a world where a big bailout does come from all the other landlords, you were at a disadvantage to them. They were more foolish with their money. They overspent it. They over-leveraged. They probably bought deals that you wouldn't because you wanted to be conservative and safe through a situation like this. And if they're bailed out, you're the one who's punished by having this money sitting on the sidelines. So,
and that's a good point. And there's this fine line between bailout being acceptable and bailout being, just this, like you said. I mean, they're rewarded for the foolishness of how they were investing in their business. A lot of these companies don't have reserves.
Right.
They don't have what they need to make it through any kind of economic cycle, and they're being bailed out for that. Yet the prudent companies, they are actually getting the short end of the stick in this case. And it's hard for me to go, oh, well, we shouldn't give anybody any money because of the circumstances. This is a little different. This isn't just a recession, right? This is a event, a natural disaster, call it.
Force majeure.
Right? The government forced everybody to shut their businesses down. Like, how do you punish people for that?
Right.
That's tough.
Yes.
That's tough.
So I totally sympathize with a lot of the people in the hospitality industry who don't have the opportunity to do anything else.
Yeah. Could you imagine right now, owning a hair salon or a restaurant or anything like that where you're just like, I can't do anything. Well, restaurants, at least they kind of can, right?
Right.
Some of these restaurants are actually thriving. And that's the other thing is, as a business owner, look at what's going on and make decisions based on what's happening and figure out how to adapt and adjust. So the smart restaurants are still making money. The good restaurants are actually doing really well. We went and did takeout the other week, and I said, hey, how's business going? And they said, we are making more money now than we've ever made before.
Wow.
And that's because they've adapted. They've made it easy for people to come in. They did good business before. It's a well-established restaurant. So what are you doing right now to set yourself up? I was on Facebook, and I don't know why, because I don't really spend a lot of time on it, but for some reason, some post popped up, caught my interest, and I saw some lady complaining about her massage business and how she can't have clients in her massage business. And my answer was, I get it, right? Okay, you can't have clients in your business right now, but what are you doing right now instead of complaining to build and grow your business? My thought was, look, why don't you go do videos on how your clients can do stretches and exercises and things like that in order to, relax their muscles, in order to basically massage themselves at home. Like, what are you doing to educate them to where when business does start back up, now all of a sudden, instead of 30 clients, you've got 300 clients.
Right.
So what are you doing today to make yourself more visible and make yourself, just a better business?
I completely agree. I think it's so easy with this to get caught up and feel sorry for yourself, because it kind of sucks. You go home, you're crazy. Like I feel like I'm in prison sometimes.
Yeah.
I think it lends itself to some depression, the feeling that, hey, this is sort of pointless. And I think what you're saying really is, it's like, yes, it does suck. Yes, like it is unfortunate. Whatever help is offered to you, of course you want to go get it.
Right.
But in the meantime, continue to build your business. Like this is the new environment. The world has changed. What can you do now?
Yep.
And I think marketing is exactly right. I think in a recession, what do they always say? The people who continue to mail, the people who market, who don't cut on their marketing budget in a recession, are the people who come through on the other end. Yep. So I think that's great advice.
Yep, the businesses that are adapting to the environment, and it's always the case, the businesses that adapt to the environment that's in front of them are the businesses that are going to succeed moving forward. That's it.
Sure.
So it's plain and simple, and that's what's going to happen. These businesses need to adapt, and if they're not adapting, they're going to be dying.
Before we get into investing, what do you think? Do you have any advice for real estate brokers out there? What do you think? What would you be doing? How would you advise them at this point as a person that they would love to work with?
Well, I think, as you said, you need to be marketing. So right now, look, I think everybody has more time probably now, or most people, right? I know I have time because I'm not doing meetings. Yeah, you and I are meeting, but this is like rare. We're 6 feet apart, by the way.
Yeah.
This is rare that I actually drive somewhere. So I've saved all my commute time. Almost every day I have 1 or 2 meetings every day where I'm driving somewhere.
Sure.
So I have more time. Most people have more time. So what are you doing with that extra time? If you're a broker, are you writing blogs? Are you calling prospective clients? Are you calling, sellers? What are you doing to actually get yourself in front of people? And how are you making a difference? And how are you being positive? Like, how are you making positive, interaction with people? How are you building your brand? Like, all those things are super important. If you're just feeling sorry for yourself because there's no deals out there, well, yeah, of course you're going to die as a broker. It's just not going to work. You have to take advantage of the extra time that you have because there's no deals out there.
Yep.
And do something about it. And then when those deals come, they're going to be coming to you.
Right. Well said.
Right? Are you calling lenders? Are you figuring out how to be the best foreclosure broker in the market? Like, when distressed properties do hit the market, if they do, are you going to be able to take advantage of that? Or are you going, oh, crap, I wish I would have done that,
3 weeks ago, I called all the lenders I work with, and I'm like, hey, if you guys have anything coming into workout, we'd love to take a look at that. We'd love to work on, we have an attorney on our team, so we can do a complicated, sophisticated deal. Don't worry about it. We'd love to take a look at everything you've got. We'd also love to broker it. Let us know. They're like, this is way premature. It's the first weekend. I think that was maybe a little offensive to some people, but
well. And Dan, what you did though is good because you, first of all, you created, like, that was unique, right? I mean, not everybody did that. Probably most people didn't. So that was unique. So you've created a memory for them. So now the next step, and maybe you've already done this, is to send them your brochure with a letter showing that, just some literature. Follow that up with an email 2 weeks later. Make sure you're continuing to connect with them, and that way 3, 6, 12 months down the road, when they do have workouts, who do they think about? Daniel Kurkowski, right?
Right.
They're not thinking about, oh, I got to go on to the website and find the best realtor. No, they already know the best person to call.
Right. That's the hope. Yeah.
Yeah.
So as it pertains now into, I guess, the meat of what I wanted to get into, how is this going to look, and what do we do about it? I know it's a loaded question, but I think it's fun to hit some ideas back and forth.
Well, and I think it's an important question, right? Because we don't know the answers, but we do want to be thinking about what the possible answers could be. So we want to be prepared, I think, for opportunity that might be coming down the pipeline.
Yep.
And again, knowing that out of every recession, out of every big event comes opportunity. And so opportunity will come out of this. I can promise you that.
Right.
So if you're not looking for opportunity, you're going to be left behind. I talk to so many people who, when I tell them when I started investing, which was 2008, they say, "Oh, you're so lucky." And they didn't start until 2014, 2015, 2016. And it's not that I was lucky. I mean, sure, I was, right, to an extent, but the luck came from actually taking action and actually looking for opportunity and understanding the opportunity. Like my brain, the bells went off and said, "Holy cow, opportunity is right here in front of me. I've got to take action." Where a lot of people were just scared and they go, "Oh my gosh, everybody just got foreclosed on. I can't buy real estate. I got to wait until it becomes the best thing ever." And when it's the best thing ever, it's too late. Then now you started investing in 2015. You had a couple of years of run up, and now you got this.
Right.
So don't wait. You've got to be looking for that opportunity right up front. Now, where I got lucky is, I wasn't as educated as I am right now, and I kind of just stumbled into wanting to do real estate investing, and then found the opportunity was like right in front of my nose. But at the same time, if you're not taking action, if you're not looking for it, if you're not educating yourself, you're going to be left behind. It's just plain and simple.
Absolutely. And I think it's going to be really interesting. And to your point, I guess, starting in 2008, there's going to be a lot of people who are going to start 2022, let's say, who are going to be in that almost exact same situation, who have the opportunity for the run-up.
Yes.
So the question then is, how do you identify when the right time to buy is? I think maybe the first thing is, in the short term, right now, the immediate, what I'm seeing is there's dissonance. Sellers they know that there's something bad happening. They know that likely their asset's worth a little bit less, but they don't know how much. And if for a lot of these guys, it's the biggest financial instrument asset that they have. So you don't want to sell your building for a 40% discount if you only need to sell it for a 15% discount. So you want to know damn sure, you want to see these other trades, you want to see comps, where are cap rates, what is the appetite like before you feel comfortable setting a price that you're willing to take for your building.
Yep.
And then on the other end, you have buyers who are looking at it and they go, well, we don't know how bad this is going to be either. So they need to price in, not just, some might price in what the average risk is, but a prudent investor, I'm sure like you or like, I know that I'm thinking about it, I want to price in the worst case scenario before I'm buying something.
Yep.
So we have these differences on what we're willing to take on a sale and what we're willing to pay now, perceiving the risk differently from different ends of the spectrum, which has caused a complete slowdown. And I don't see a way for, eventually the dam has to break and some transactions are going to take place. Some exchanges are going to come through. Sometimes people just need to sell. You're 90 years old and you got to pay for X, Y, and Z. You're going to sell your building. It happens. Until those transactions start happening, people just don't know. And so it's kind of a weird chicken egg thing. How do you see that playing out?
Yeah, it's tough to exactly know, but it's exactly, it's just what you said. It's just going to be, it's this chicken and egg thing, right? And it kind of also depends on how deep this cut goes, right? Right now it's only been, 4 or 5 weeks? Mm-hmm. So it's the cut isn't that deep. Most landlords got their rent, some didn't. But the ones that didn't hopefully had reserves. If you didn't have reserves, obviously you're going to go down a lot quicker, right? Mm-hmm. So I think it's just keeping an eye on the market, keeping an eye on timing, keeping an eye on just where prices are going, what's going to happen. And again, so much is still up in the air. We don't know. But let's just assume that this does get bad. Let's just assume that people start needing to sell their properties instead of just right now wanting to take advantage of an amazing market, right? Or
right.
Not right now, but 4 weeks ago.
Sure.
So let's say that happens. Well, what you're going to see is this snowball, right? It slowly starts to this tiny little ball, and we keep on rolling it. And all of a sudden, we get this big ball that we make the snowman with, right?
Yep.
My son and I just made a snowman like a week ago, right? So now
Love
I'm thinking
doing that in
snowmans.
April, right?
Yeah. But that's what's going to happen is you got this first property comes on the market, second property comes on the market. Those get sold. But then our sellers start putting more properties than our buyers can handle. Mm-hmm. And once we get that breaking point, then the sellers are, especially the ones that are desperate, are going, you know what? I'm not desperate, but how about we just drop the price by 10%? You know what? I'm not desperate, but let's drop it by another 10%. You know what? I'm freaking desperate. I need to sell this property. Drop it by 20%. Let's see if we can get this thing off. That's when you're going to start to see these deals come. Now, when should you start buying as a buyer?
My buddy always says, he's like, we're all rich as long as we decide that none of us are going to sell.
Yeah.
Once we decide to sell, now we're broke.
Yeah. Well, and some people are going to be not even deciding. They're going to be told to sell by lenders.
Right.
You've got, especially, so my world, multifamily and commercial, you've got loan covenants that you have to meet certain requirements. And if you can't meet those requirements, the bank is going to go, sell your property. Get rid of it, or we're taking it. And you're going to have to sell it. And so you might not even decide to sell. You might be told to sell.
Sure.
So that sucks, right? So as a buyer, like, when is the right time to buy? There is no perfect time. I'll tell you that, first of all. The time is when you can look at the cash flow, buy on the current numbers, on the current cash flow, and you can know that with conservative underwriting, you're still going to make it through a tough time, which we're going through right now, right?
Yes.
And that's tricky because, okay, what's conservative really mean, but we want to stress test through some previous recessions. We want to look at what's happened before. We want to look at current events, what's happening. Our rents going down by, 10%, our vacancies going up, likely both are happening. So, okay, well, let's stress test this through and see how bad it has to get before we lose money on this building, before we're forced to sell. And so once you can get to a point where I can buy this building and I can make it through, and hey, there's some pretty dang good upside here, then it's time to buy. When I look back in 2008, when I first started buying, I was buying these properties that they were cheap, right? They were cheap, but I would buy them, I would renovate them, and when I was done renovating them, let's say they were worth $150,000. And I was buying mostly single families and duplexes at the time. So they're $150,000. Well, I would refinance them based on that. I would rent them. And within 2 years, they're now, instead of $150,000, they're worth $105,000. So I lost money on the buildings, but they were cash flowing at $500 to $800 to even $1,000 a month.
Right.
Like, I didn't care how much they were worth, truly. I cared about the financial performance. So what's your business plan and goal, and can you actually achieve that? I think that's what you have to really look at as a buyer. Could you lose equity in your building in the short term? The answer is yes.
Yeah, well, I think it's important then to break out the difference between the asset market, buying the actual real estate, and the space market, because you talk about the ability to carry yourself through the bad times. That's a demand side function of space. What is the value of the space that you're offering? And I think the space that you're offering is very highly in demand, and you position your business, this is me as an outsider looking in, to deal with this exact situation. You've been prepared for something like this because you're picking space that's in high demand, that people have been competing for, that is, everyone's saying, hey, there's a housing crisis, there's not enough units at this price. You can look at it from how how much demand is there to release the space? And commercial real estate, you can also look at it too from, how strong is that signature? Is Medtronic the tenant on your building for the next 10 years? They'll probably keep paying. You can feel pretty good about that.
Yep.
How durable is that income stream? And what I think a lot of people are finding, myself included, I bought a B-class retail building in Cottage Grove, and now it's getting to be a lot harder to find someone to find that space. That was harder space to fill before this, much, much harder now. So looking at it from the demand side and making sure that you're adhering to the good fundamentals of investing in real estate, I think is more important than ever.
Yeah. Well, and one thing I want to speak to that too is when we have to look at, we've got our piece of real estate, and you might be sitting here and go, man, I've got great tenants. Let's just say you've got this building that's full of like just awesome tenants that aren't being affected by this recession, right? Yep. This crisis. They're not affected at all. This is great. I'm going to make it through. Our building's going to do just perfect, right? Well, guess what? If the other buildings all around you are not surrounded by those amazing tenants and they become vacant or have some occupancy issues, guess what they're going to do? Lower their rents, offer amazing concessions. And what's going to happen to your tenants? They're going to go, my lease is up.
Sure.
I'm going to go to this place that's renting for, a 25% discount, a 30% discount. And all of a sudden your beautiful looking building that had these amazing tenants might not be so amazing. So we want to look at our building now, the 10-year lease by Medtronic, amazing, right? That's your tenant. They're locked in for 10 years. So if that's who we got, we're pretty good. But if we've got tenants that are, whether it's residential or commercial, that are locked in for shorter leases, we got to really be concerned. And when we're buying these assets, we got to really understand that our building might be strong today, but is it strong in the future? And that's where we can get caught up when we're buying these buildings. And we go, I'm buying this apartment building and it's 98% occupied. It's in a fantastic area, and I'm buying it at a 6 cap, and it would have sold for a 5 cap just 3 months ago, and so we thought, we got this great deal. But what we didn't realize is there was cracks all around that building.
Yep.
And your building is 98, but every other building around you is at 92, and their rents are going down by 20, 30%. And eventually your building is going to get swallowed up into that, and it's going to go down too. So we got to look at everything around it. I don't mean to scare people, but just be aware of what's happening around you, because it's going to happen to your building as well. And you mentioned the strength of multifamily, and I have set myself up in that asset class for a reason. But here's the other truth of it is multifamily is still, it's going to be affected by this. People will figure out ways to cut costs. So you're going to find yourself a roommate versus, paying $1,500, $2,500, whatever it is for rent. You're just going to find a roommate, right?
Sure.
You're going to figure out ways to get creative to still make ends meet. And so now if you find a roommate, that means somebody else lost a tenant.
Yep.
Right? And so now occupancy goes down. Some tenants aren't going to pay. There's things that are going to happen. So multifamily is they're going to get hit.
Yeah.
And it's the smart landlords, the ones that have reserve accounts, that are going to be the ones that can make it through. And again, when you're looking at buying a building, make sure you have a damn good reserve account. That's something that I've looked at on myself, and I feel pretty good about my reserve accounts. But in the future, my reserve accounts are going to get even bigger.
Yeah.
And I'm going to be even more prepared for this to happen in 2025, in whatever.
Yeah.
It's just going to, I want bigger reserve accounts. I want to be more prepared and be just well capitalized.
Sure. Yeah, I think that's probably also a function of now having something to preserve too. Like you have something substantial that you need to protect.
Right. Yeah.
So what I'm seeing is, and hearing from you, is on the space market, short-term decrease in demand as a result of people bunking up roommates, maybe moving back with mom and dad to save
maybe
money.
moving back with mom and dad. Yeah.
And we're definitely seeing that. We had 4 restaurant deals from a pretty big restaurant in town that were going to be going on this year, and they just completely tapped out.
Said no. Right.
So retail, office, I mean, that's really tough space, anecdotally, from what we're seeing. I don't want to sign a lease right now.
Yeah.
I don't want to sign a long-term lease.
Yeah.
You're worried about your business. You're worried about, hey, am I going to sign a lease with 10 brokers that we have, or then we're going to be 6, in a couple months, and we have this bigger lease obligation. So I think there's some challenges there. I think multifamily, it seems like is positioned about as well as you can be, and
Correct.
And to me, industrial as well.
Industrial is great.
I see increased demand
Warehouse
coming over time.
Yeah.
And that's the asset that we've, I put this whole pitch deck together, did this presentation, we were going out, we were raising money, and then this happens. And I think a lot of people came up to me and they're like, are you bummed that you put all this time and energy into doing this presentation because we had this is the per foot, this is where we're buying in these markets. No, this is where the opportunity comes from. We're going to have access to 5 times more deals that check these boxes. And a lot of this is still going to perform well because, again, you look at the demand side, you look at e-commerce, this isn't going to hurt e-commerce.
No.
You look at...
It's going to help it.
Exactly. And then onshoring. We really recognize the weaknesses in our supply chain. I think that's going to bring some more manufacturing back here.
You got it. And companies are going, wow, we ran out of this stuff, and we don't have room at our facility, so let's just lease this cheap warehouse space. Right. We're going to store some stuff in there, and we're going to be prepared now. I think warehouse is a very strong place to be, and there's several other industries or facets of real estate and even business that I think have good opportunity.
Maybe we'll do a warehouse deal together through this.
There you go.
That'd be fun.
It'll be fun.
Yeah. So short-term demand for all of these assets, I think it's going from the space market back to the actual asset. I think it makes sense. People are worried about what's the value of these going to be. There's also a decrease in demand as a result in the less availability of credit. Banks are tightening. What have you seen on the credit side? Are banks requiring more in reserves, offering different terms?
Yeah. I mean, there's a lot of different lenders out there, right? So again, in the multifamily space, we deal a lot with agency debt. So Fannie Mae, Freddie Mac, HUD.
Yep.
Right. Those ones are open for business. HUD is probably the best open for business. They're not requiring a much different, and you can get still 1.18 debt service coverage ratio, just some amazing terms, 35-year fixed. I mean, amazing stuff. But the problem with HUD is they're a pain in the butt to deal with. You've got tons of reporting to do. You can only take money twice a year. You can only take profits twice a year, so you have to have pretty good reserves sitting there. And you can... it takes you 6 months to get the deal done, to get financing. So Fannie Mae, Freddie Mac are your big agency lenders, and they're requiring 12 and sometimes 18 months worth of principal and interest reserves. So pretty good amount, right? And previously, you could get deals done for even as little as 6 months.
Wow.
So when you talk about the demand for properties, we have to look at, what people's capital is. And people are basing their decisions on the capital they have to bring to the table. Well, now you have to bring in twice as much reserves to the table. That means we have to have more capital, which means we can't purchase the property for as much money.
Right.
So right there, property values just decreased just because of that. Local banks, let's go with national banks. National banks have basically shut the door on commercial real estate in general, multifamily. They're the first ones typically to do this, though. They always leave the game as quickly as possible, and they're the last ones back. They won't be back until the market's frothy again and the bubble's ready to burst.
Sure.
It's funny, the national banks, I don't get them, but they are at the peak of lending when the bubble is ready to burst, and then they go away when it's perfect time to lend.
Sure.
The local banks are cautiously moving forward. Some of them have shut down, but they're cautiously moving forward, I would say, for the most part. They will be very cautious right now. They're going to require bigger down payments. They're probably going to charge you a little bit higher interest. They're going to be working with better credit lenders and better properties. They will be the first ones to open their doors back up, though, as things start to shake out. So they're going to be your friend. Those are the banks that you want to make big relationships with right now. So it's definitely a different lending environment. 100%.
For sure. So the money supply in the short term is shrinking.
Well, and investor money too,
Yeah.
right? Investors are so it's across the board. Everybody is cautious, and nobody knows what's going on. I think that's the biggest problem is there's no certainty.
Yep.
Right now, and so when there's no certainty, well, why am I going to invest in this deal when I don't even have a clue what's going to happen in the market? So we have this lack of certainty, which means everybody's closed for business.
Right.
And until that certainty comes around, we won't see. I don't think a tightening or a loosening. I think it'll be only a tightening.
Yeah, I think so. Anecdotally, are you more or less likely to buy something right now? Right?
Yeah.
I think with the credit markets, the way that I always think about it is you kind of have the snowballing effect, as you described earlier, where the problem is people lend to you because you have a high income, right? They want to know that you have the ability to pay it back.
Yeah.
And in the short term, incomes are going down.
Yep.
Like there's no question about that.
Yep.
Right? And the other piece that they look at is what's your collateral as your ability to repay.
Okay.
And if the value of your assets is going down, as they are, as we've discussed earlier, so you have both of these factors at once, both pulling back credit, meaning that there's less money to deploy into these deals, which is decreasing demand, which is why, and then uncertainty, general desire of consumption is going
they
down.
want to make sure that whoever's in your building is going to pay the bills.
Right.
And right now, there's nobody that really understands if anybody's going to pay the bills.
Right.
So, other than the federal government.
Now, the countervailing force now, right, is all the quantitative easing that they're doing.
Yeah.
The last time I saw you posted an awesome article, I wrote one too last week, and at the time I wrote it, it was $6 trillion was the Fed's balance sheet.
Yeah.
It was at around $4 trillion before this started.
Right.
And the projection is that it'll hit $10 trillion
pretty soon
by 2020.
And I think we could blow way past that.
Which is crazy to think about, right? Because you're now reintroducing money to make up for the loss of credit, which increases demand and means people can pay more for these assets. Mm-hmm. Also, if you keep interest rates low. I mean, now that's a leveraged increase in what we're able to buy, increase in nominal GDP, the amount that people are able to spend. So when you think about the long run, it makes sense to me, these asset values are going to go way, way up. What time frame, we don't know.
Yeah. It'll be interesting to see because it doesn't affect all areas equally. Mm-hmm. Or at least it hasn't. And this new money that's being brought into the market it is new money, but it's being given to mostly just the middle class, right? It is being given to some businesses and even large businesses, but a lot of it's middle class people, and they're not working, right? And so what will that do in the long term as far as inflation? I'm not so sure. Like, I don't think I've really formulated a good opinion on it. Part of my brain says inflation, price increases everywhere, especially hard assets. Part of my brain says I think it'll just continue to be as is. We'll have just regular inflation. Look at what happened after the last infusion of a ton of money. We actually had below average inflation. And could that happen again? Maybe. I guess I'm gonna sit here and say I'm just not smart enough to know right now what's gonna happen. And
I dove into that pretty deep. I have a thought on that. So the CPI is usually what people are quoting when they talk about inflation, and it has been pretty steady at 2%. But what the CPI fails to take into account is our financial assets. And the way that they count housing is really weird. They don't say, hey, you bought this house, this is what the value would be, or they're not looking at tax value. They say, what would fair market rent be for that house? And how do you come up with that figure? I think all of us anecdotally know who've been investing. The stock market in the last decade went up 380%. I mean, anything that you can leverage and use these low interest rates, the lower interest rates are, the more people invest versus save. Because you can't just have your money sitting in an account earning you nothing. You're losing money to inflation. So people deploy it into financial assets. The financial assets are somewhat finite. So you have all this extra money that you're creating. Demand increases as everyone's trying to gobble them up and competing and pushing cap rates to 4.75% in the Minneapolis apartment market for Class A stuff. So I think
Class B stuff, man. It's crazy. Yeah.
So I think in the long run, it's going to really inflate values.
If you're right, get your hands on real estate. That cash flows, right? Because you got to be able to make it through whatever bumpy roads we have in front of us.
Well, the issue is, a lot of talk, I'm going to go somewhat political for a second, but a lot of the talk of the wealth gap in our country, I think, isn't really doing a good job of understanding it from an economic position, where all of this money that they're printing, it needs to come from somewhere. It can be paid for in two ways. It can be paid for in taxes, or it can be paid for in inflation, the money supply. That's it. We're not paying for it in taxes. We all know that's not going to happen.
Yep.
So it's got to be in inflation. Well, who benefits in a world where there's a lot of inflation? People like us who have the capital to go buy a financial asset, to buy someone who invested in the stock market in 2009 that got a 380% return on it.
Yep.
Not the person who was just using it to buy food and pay rent. So by doing quantitative easing, this is kind of the argument against Keynesian economics, is that by doing it, you really actually long-term are having the opposite of your intended effect.
Yeah.
So that's what I think will happen. I think that's kind of why it's so interesting to look at it, because what's the right thing to do? Well, it all matters what timeline we're talking about. Because in the end, if we all agree that it's going to go up in the long run, buying at the peak of the last recession probably wasn't that bad either. If you index the previous recession to 2007, everything went up 30%, something like that.
Yeah.
It'll be okay.
You still made money.
Can you survive in the short term? I think that's the first question.
Correct.
And then, the second piece is, are you then trying to time the market? Is that your strategy? Some people, if you need to sell in the next couple of years, today's the best day to sell. It's not going to get better for you in the short term.
I agree.
But if you're trying to time the market, when is the low point? How do we start to recognize that? And my only thought is, okay, when does supply, the percentage increase of supply added, start decreasing?
Yep.
Right? Because then relatively the money supply is stable at that point, and there's less assets going into the market. That likely will drive these values up. And that's where you just have runway, where all of the lending restrictions start relaxing a little bit. People start competing for what is out there. It's hard because if you try and tie it to one specific item, if you're like, well, when banks start doing this, I think you can get caught in a trap and it ends up being a little bit myopic. But if you're like, okay, when is consumer confidence back? When is supply of inventory available for sales? When does that start to decrease? That is, I think, when you can kind of start to break it down.
So I'm going to disagree with you.
Okay.
And I agree that that's a great time to buy. But what I'm going to propose is that you've missed a large window of opportunity there by waiting for consumers to be excited again, by waiting for some of that stuff that you've mentioned. If you can buy in a 2008 when consumer sentiment is at an all-time low, when unemployment rate is at an all-time low, and you can buy at that time, I think you've really been able to buy a lot. So if I look at maybe 2012 was probably when things started to really come back, or start to, right? It took a long time. But if I didn't buy anything from 2008 to 2012, I missed out on millions of dollars worth of real estate.
Sure.
Now this is different, right? Unemployment typically doesn't take place in a few week period of time, right? We don't lose whatever millions of jobs we just lost, right? When you look at the last one, that happened from 2007 all the way through like 2010 to get to the point of the max job loss.
Yes.
Okay, so this one's different. Now you can't say, well, we lost all these jobs, now's the time to buy, because the market hasn't truly reacted to it yet.
Right.
Real estate especially hasn't reacted yet to what's going on. So this is a little bit different, but I think you're always taking a risk if you don't do what you said. So if you do what you said, you're going to be safe. You're going to be buying an asset at the lowest or lowish, close to it, point. And you're not going to lose any value. But you're also going to miss that opportunity that could be a pretty large window of opportunity.
Sure.
But you're taking a bigger risk, right? So by buying in 2008, I took a bigger risk. Like I said, my properties lost value. I took a bigger risk in 2008, 2009, 2010. But had I waited until 2011 or 12, I would have missed out on millions. So
sure.
That's my argument against doing it.
I agree with your strategy, and that's the strategy that I'm looking to employ as well. I don't think I explained myself very well. I was more saying, I think when you see the consumer confidence shift, that is when you know that it's going to start going back.
That's going to start to go up 100%. Yeah.
I think the right way to go about it is to be dollar cost averaging on the way down, to be buying an asset that you know you're buying for value.
Yeah.
Because again, if we think it's going to go up beyond where it was before,
which
if you
it
have
is.
Exactly. Then you have a stable income, and you're comfortable buying it for the income that it produces. Take every single opportunity that you can to buy the entire way through. Because, I mean, I really started trying to buy commercial real estate in 2018 and started putting millions of dollars into deals. And it was so hard to find anything that I found interesting.
Yeah.
So, I think for the people who never went through a contraction before, it's going to be an eye-opening, amazing time where you're going to see deals, and it's going to be different. Maybe tell us for someone who didn't do it, what am I going to see?
Well, I'm going to go, first of all, start by saying things are different now. We have podcasts. We have YouTube and social media that's like just gone bonkers since the last time. Now, did we have YouTube and some stuff back in like 07, 08? Sure.
But not effectively, yeah.
You're right. The best way to get educated in 2007 to 2008 was to read a book, a hard copy book.
A what?
Yeah, exactly. To listen to one of those audio CDs, right? That's how you got educated. Now you listen to a podcast that was recorded within the last 2 months.
Right.
Maybe even within the last half an hour. You know? And so it's going to be real time. So I think your window could be smaller too. I think you're going to find out what other people are doing a lot quicker. So it'll be interesting. But what happened the last time is the fear took over. People knew there was great opportunity, but the fear took over, and they weren't buying. So you might go, I hear all these people are like, I'm so looking forward to the next time that happens again. I'm going to be ready to buy. And my response is, are you sure? Are you sure that you're going to be able to get out of your own headspace, right? And that's going to be the most challenging thing. Yeah. And again, it's different this time because other people are going to be telling you to get out of your headspace, that you're in that headspace. You're going to go, oh, I am. Oh, there is these deals. So that it could make it speed that process up.
Yeah, how much of a mitigant do you think that is? Because there are groups that I know who are sitting on dry powder. There's this investor that we are fortunate enough to be around, owns 11 million feet, and he was doing about 50% LTV on every deal that he was purchasing on purpose in preparation for this. Yeah. And I think people looked at it as an outsider, and they're like, why wouldn't you want to get longer term debt on these great, huge industrial buildings that are going to have demand forever? He's like, well, and now he looks like a genius.
Looks really smart. Probably has a ton of cash reserves sitting around. And even if his tenants don't pay, which he's got industrial, so they're probably going to pay. But even if they don't pay, it's probably not going to kill him because he's got this cash. Now, does he want to lose his cash, right? Does he want to spend his cash trying to pay for his mortgages? No, he doesn't want to spend all his cash, but he's got it. He's ready for this to go on for a long period of time. He's got low debt. He's got good reserves. He's solid. Now, people would say that I heard it a lot because My properties here locally are leveraged at about 35% blended, 35% loan to value. Why not take another mortgage out? Why not take a line out? Why not just refinance them? I can get 75% loan to value because I don't want to.
Yeah. Because
I want to be in a good position. If my tenants stop paying me tomorrow, well, it would suck. I guess if everybody stopped, that would hurt really bad. But, if a good percentage of them, I could still make it through.
Sure. So my question, do you feel like people in the previous recession, I know you were just getting in there, do you feel like people are in a better position now in terms of how leveraged they are?
No. I think it's different this time, right? So probably, but here's what I think. There's a lot of false. There's like a lot of people are hiding behind more debt and less reserves than what you think. So I think that's the biggest risk, is the reserves. And I've mentioned that obviously a lot, but I think there's a lot of people that just don't have capital reserves, period, or really much to go by at all. And so if you don't have reserves, what's going to happen when you get a couple of rocky months? You're not going to be able to make it through, and you're going to freak out. You're going to crawl in your little hole, and you're going to start licking your wounds. And that's what happened the last time. Now, we never saw 100%, 110% loans.
Sure.
Well, I shouldn't say never. I don't know. Maybe, but not in my world, at least. But we did see some crazy debt service coverage ratios where the banks would just get a little sloppy on their underwriting, and they would, okay, you're at 1.2, 1.25 debt service coverage ratio. But when reality hits, you're actually at like a 1.05, 1.1.
Sure.
So we're underwriting, being a little more forgiving of expenses, a little more giving on the income.
Yep.
And that's the other thing when we talk about lending. These lenders are no longer going to do that. Fannie Mae, Freddie Mac, forget about them telling you, okay, yeah, you can have that building repairs and maintenance. Yeah, we can see it at $300 a month. We can see your unit turns at $150 a month. Nah, forget that. That's not going to happen anymore. They know better.
Yeah.
They knew better back then, but they really know better now.
Sure.
So
last question before we sign off here. I hear a lot of, I want to address the residential real estate agents, because I think they're asking and trying to figure out, how is this going to affect the housing market, the traditional housing market? And I've seen a lot of reports that I would say the data that is being cited is kind of irrelevant to the situation and used to encourage people to want to go out and buy houses.
Yeah.
What's your thought on how this is going to affect the single family?
I actually think in the short term, people are going to get hurt, right? In the short term, there's some people that are going to get foreclosed. I think the biggest risk is your Airbnb, your vacation rental type people. So I think there's going to be some pain and some hurt. But honestly, in the long run, I think single family is poised to do really well. If I were a realtor right now, I would be contacting every single person that lives in an urban high-rise and telling them how beautiful it would be to own their own piece of real estate with their own backyard near parks and nature. Because guess what those people are doing right now? They're sitting in their 600 square foot cell block. They can't get outside. They can't do anything, and they're driving them nuts. And the cool thing, they were in this apartment because they could go to the bars and the restaurants and go to the nightlife scene. And if they didn't feel like doing that, guess what they would do? They would hang out at the pool or the rooftop, whatever. And it's like, and none of that is there. And they've got to they're on the 52nd floor. They got to walk down this hallway that they can't get 6 feet away from the person that's walking the other direction. And then they go into the elevator and they pray that they won't run into anybody on all the way down, yet that elevator stops 6 times. And each time somebody gets in and goes out. And they're going, oh my gosh, I just can't wait to get out of here. And that realtor that contacts them is like somebody sent them from heaven. right? And now they can buy the first piece of property. That's what I would be doing if I was a realtor. I would be hounding on those people, trying to get clients out of urban high-rise apartment buildings.
Wow. You sold me, man. I'm living the North Loop. I'm like, let's go. Let's get out of this place.
So I don't know. Short term, there's going to be pain. There's going to be people that lose their properties. I think we're in a lot better position financially, leverage-wise, and just overall debt-wise as before. And interest rates are staying down. I got news for you. I think interest rates are going to be close to 2% by the end of the summer.
Sure.
I really do.
Mm-hmm.
I really do. I think you're going to be able to get your own house financed between 2 and 2.5% by the end of this summer. And man, talk about a low mortgage payment.
Yeah.
So that's only going to help it. I see it being strong. Now, would I encourage somebody to say, hey, now is the best time to buy? It's probably not the best time to buy, but at the same time, if you get a decent value, I don't think it's the worst time to buy either.
Sure. Awesome.
And maybe I'm wrong. Maybe it's going to all crash and burn.
Let's put that caveat on everything that we said today, right? Maybe we're wrong. Who knows? So.
I think one of the best opportunities right now in business, or in all through what we've talked about, I think warehouse is great. I think suburban everything is actually better than inner city urban. I think we're going to shift from urban to suburban. And I think look for business opportunities to buy. If you are business minded, if you've ever wanted to own a business, look for opportunities to buy. Look for things like manufacturing, like tech, things like that, where you can buy a business from, a guy that's wanting to retire, a guy or gal that wants to retire, and it's just done.
Yeah.
This whole thing just like rocked their world, and they're like, screw it, I'm out of here. I think there's going to be opportunity there. And real estate, I think there's a lot of different opportunities. You just got to look for it. And here's the other thing is, we've already talked about a paradigm shift. So what's the shift of the paradigm? What's that going to look like, and take advantage of that? We never had these turnkey properties prior to the last recession. Mm-hmm. People took advantage of it. Airbnb vacation rentals. I mean, people took advantage of it. Now they're getting slammed right now, but if you were well positioned, you're fine.
Sure.
So,
yeah, that's great. I think there's also, you'd kind of addressed the paradigm shift. I think that really is beneficial for people like us. We're younger, on the younger side of this business. I think flexibility, like having to change the way that you're doing business, it's a little bit easier. So I think for the young people out there listening, now is the opportunity. A lot of the older guys are just going to go, you know what?
I'm done.
It's fine. Yeah. I'm done. I got all my money.
Yeah.
You can look at some of the big portfolio transactions that have taken place. If you saw the big one CSM just did, people are getting out of those portfolios. There's a new world order coming. So
I really hope these retired people finally want to sell their properties.
Yeah.
These older people, like, they just hold on to them forever. And it's like, you just sell me your property. I want to buy it.
Exactly. Well, Todd, thank you so much for doing this.
Yeah, man.
I thought it was just be great to do a one-off and talk about how this is happening. There's just so much misinformation out there, a lack of information, and it's great to get it directly from the source.
Well, and there's a lot of unknowns, and clearly, like, everything you and I have said today is probably 50% of it's going to be wrong, right?
Yeah.
But the important part is that people are critically thinking and listening to us. They're listening to other people. And by the way, stop listening to CNN and whatever other news sources. Like, they are not providing you good data. They're not providing you good information. All they're providing you it's just garbage in.
Yep.
And just stop listening to them. Listen to people who are going to actually give you good, real information and not just try to scare you. It's just they sell on scare. Right?
Yeah,
that's it.
Agreed. Listen to Pillars of Wealth Creation.
Yeah, there you go.
Thanks, Todd. Thanks, everybody.
See ya. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.